Good afternoon, ladies and gentlemen. Can you hear me? Is that all working? Good. Right. Thank you very much indeed for giving me the opportunity to have a chat with you this afternoon. My guess is that some of you are companies, a lot of you aren't. So hopefully this will have interest for many of you. And those who are companies will either have sought funding or about to seek funding. So I hope there's some pointers here which may be of help. So my title is entitled How to Become Investment Ready. Firstly, I'd like to talk a little bit about who we are, just to give you some context. As Tom said, we are a venture capital firm based in Newcastle. We invest in high-potential, innovative businesses with the commercial footprint in the Northeast. What that means is that you don't have to have your entire business in the Northeast, but you have to have a significant part of your activity here. And as of May 2018, we've been investing in the 27 million Northeast Innovation Fund. As a company, we've been around since 2004, so this is the third fund iteration that we've been running, and currently have around about 100 million under management. We're an early-stage investor. We're financed by the European Union and the European Investment Bank to be an intervention fund in an area which hasn't had much early-stage venture. And we're one of the main catalysts for getting venture money into the region. So we invest in startups and SMEs with scalable business models and global ambitions. We're not looking for invest in local businesses. We want people with real ambition. And the six of us actually doing the investments within the organization, varied backgrounds and technical expertise in multiple sectors. So I'm a life scientist for my sins. So this is probably well known to all of you, but what is venture capital as opposed to any other form of financing? Essentially, it's an investment by a third party in your business. The expectation of that third party, which is the clue is in the name venture, is that they're looking for a significant return. This is not a stock market return. This is a multiple of money which they're looking to get. If you think of 10 times the money that they put in is the sort of thing that they're looking to get out of it. They do this in the sure and certain knowledge that most of the companies they invest in will go bust. The statistics on companies going bust are absolutely horrifying, but basically 8 out of 10 businesses, or as high as 9 out of 10 businesses, don't make it. Now that's across the board, so it's not specifically in healthcare photonics or anything else, but it's a tough thing setting up a business. Also, if you want to be a business which has a valuation of $1 billion or more, the odds, again, just as straightforward odds, for every 10,000 companies invested in, one will make it to that level. So the odds are stacked against you to become a unicorn, but that doesn't mean you can't. Early-stage VCs are prepared to invest both pre-product, pre-revenue, and basically where traditional sources of financing, like banks or the larger VC funds or private equity, are not yet prepared to invest. So as you go through your life from a startup through to a significant business, you'll have a trajectory of funding and a trajectory of profits and earnings and spend, etc., which may look something like this. You've got your idea in your garage, it's an absolute startup. This is a proof of concept of the technology you're trying to develop. And you need 50 to 200K maybe to get the thing, to actually see whether you've got something which works. Typically, this is an area where you might go to your friends, you might finance it yourself, you might get your family to stick some cash in. There are some people who are actually specific proof of concept investors, and there are specific proof of concept funds. Part of our fund is actually earmarked for proof of concept investment. Once you've actually shown that you've got something and you've got some interest from the market, you can move on to a seed round, where typically you're talking about 100 to 500,000, though these numbers are going up, particularly down south. And this is where people like ourselves play, the early stage VCs, and also quite a vigorous community of angel investors. This is also where crowdfunding happens. This is where SEIS funds, EIS funds. So this is the area in the market where we all play. Once you've got your traction, you're beginning to make some revenues, you've got a product which looks as though it's going to be a success, it's growing, that's when you move into the main VC market, where the VCTs and the larger VC funds typically play, and you're looking to invest maybe 500,000 to £2 million. And thereafter, hopefully if all goes well, you're looking at development capital, entering new markets, building new products, etc. And this is where the larger venture capital houses, private equity houses, and you also have the opportunity of a stock market listing. Investment readiness looks very different at each of these stages, as you can imagine. A development capital deal looks very different to a seed deal. But clearly, so what I want to do is just talk primarily about seed and Series A, which is where we work and where we have the most experience. Having said that, at all stages, investors are going to look at the following 6 items, essentially, which is the idea, the technology that you're trying to develop, you have developed, the team which is doing it, the market in which it's operating, the customers to which the customer base they serve, the competition that they face, and also what it takes, how much money it's going to take them to get to a desired end result, which may be a purchase by another business, it may be profitability and stardom, it may be a stock market listing. It's all sorts of, where you reach escape velocity and you don't need further venture funding. All of these are critical, but above all else, it's the team which wins it. And whenever we look at businesses, it's the team which is the critical success factor for any business which comes for investment. And that's, you'll find almost all VCs will say that. So just to go through these in some sort of order, what you have to be able to convince people like ourselves is that the idea has legs. What is it? What are the development requirements? So what does it take to become ready to sell? This is particularly true in regulated markets like the ones that you operate in. What is the technical development? What is required to convince people it works? So, for example, does it need clinical trials? Does it need regulatory acceptance? What are the regulatory hurdles that it has to have before it can reach market? And the next point is actually, how are you going to sell it? Is it something you're going to have to build a big sales team for? Is it something you can use distributors? Is it something which you're going to license? All sorts of different ways that you might go to market. And what these are the things that we're looking for people to have thought about, at least, by the time they come to us. Last but not least is intellectual property. I won't go into intellectual property in detail because this gets covered regularly, but you're looking to build a defensible position for your business, so such that if you start making sales, then people are going to come to you rather than to come to a cheap price competitor, because they can't. And that IP is more than just patents. It's also brand. It's also marketing strategy. It's also your reputation. It's a whole group of stuff around building a defensive moat around your business. The team, most important, as I said. Who are you? What is your background? Where do you come from? Why are you the right people with the idea that you're coming to us about? Who does what within the team? Often you get teams which are very amorphous. Everybody does everything, and people have a habit of stepping on each other's toes. And consequently, this is a point. We like to see people who understand where everybody fits within the team, and not so much have specific jobs, but know the roles that they're going to take. Thirdly, you need to be very dispassionate about your team and realize that you are not going to be the full, perfect article by the time you come to seed and Series A funding. You will have gaps. How are you going to fill them? Are you looking for contract manufacturer? Are you looking for someone to develop some software for you? Are you looking for a regulatory person who can help you out? Your finances, who's doing it? Is it someone who you can control? Do you need to recruit people? And is part of the investment to recruit people? And then more about the team ethos. How ready are you to take advice? I'm not saying that venture capitalists have all the answers, because we certainly don't, but we do like to see teams that are open to take advice from others and actively looking for people to help them rather than being very closed in. Some people are very sort of internalized, and they're often the ones which have real problems. And as a sort of corollary to this is, have you built an ecosystem around you? It's quite a good measure of how exciting an idea is how excited people are about it, and particularly people that we rate and people who we really believe can help the business on its way. So that's particularly mentors, potential non-executive directors, etc. And last but not least, are you a team? Do you actually like each other? Because it's a pretty tough time out there if you're a startup business. And if you don't, everything's going to go horribly wrong quite quickly. So it is quite important to get on and actually behave as a team rather than a separate bunch of individuals. The market. So what is your market? Is it a new market which doesn't exist yet, which is tough to compute, but you can make assumptions? Is it an existing market? One of the nice things about pharma is you know exactly how many people have got the disease that you're trying to treat. So some of these things are really quite easy to do. Is your timing right? And this is a question that we ask everybody, is are you too early or are you too late? Because actually, if you're too early with a really good technology, but the market or the hardware or the market just isn't ready for it, you're going to crash and burn just as if you came in too late. Examples of this were people working on messaging systems when there was many, many different software platforms around the mobile phone market, and a Samsung couldn't talk to a Microsoft, etc. Some great ideas, but they didn't work until smartphones came out. So the timing was wrong, and you'll see the same thing. And it's the same thing with existing markets. If someone has already owns it, you may be too late. Or if people are beginning to see the shape of it, you may already be too late. What we want you to see, what we want you to talk to us about is what your available market is. That's the total, i.e. what your product or service can serve. But then, ultimately, your serviceable available market, which is a realistic view of what, in your current state, is the market that you're actually targeting. We want to see you to segment the market, so see where you really fit. Our problem with people is that they tend to come to us and say, the pharmaceutical industry is worth $10 trillion, we only need a percentage of it, and we'll be very, very rich, which doesn't really help anyone. And you see a great deal of this. Understanding and being dispassionate about what your market is. If you've got your product market fit right, you should own that market. And that means having a more than 50% market share. And that's what the segmentation means, particularly when you're in the sort of early stage innovative pathway that you are. Secondly, we want to make sure that you're on the critical path for people. I have businesses which intellectually have a fantastic product. You invest money, and then that enables you to save money down the line. The paybacks look absolutely fantastic. You'll get your money back in 18 months, and thereafter it's all jam. It all looks great. And people have real trouble buying them because it isn't about selling more stuff. It's always about a project which gets bumped for something else. It always sits down at the bottom of the portfolio. So you've got to see where you are on the critical path. And for example, in diagnostics, do you actually make a difference to the patient journey with the diagnostic test you have? If you don't, you won't sell it. If you do, you will. It's fairly straightforward. So what we really want to see is a new product in a fast-growing market, but there's many permutations and combinations of that. The customer. Who is the end customer? It's not often who you think it is. For example, the doctor may buy something, but it's the patient who's actually the customer. Who makes and influences the buying decisions? Again, smaller, early-stage companies have a bad habit of going to see very big companies, having a meeting, and get terribly excited because they can have another meeting. That doesn't get them anywhere and just wastes an awful lot of their time. And the opportunity cost of that for small companies, when there's a huge asymmetry in the relationship between a large company and a small company, can be devastating. So you need to understand who makes and who influences the buying decisions and make them your champions. Another thing which can kill a small company on limited budget is what is the buying cycle. A 2-year buying cycle may put you out of business. So again, you have to understand this, and you need to have a think about this before you start going to funding, because it influences the amount of money you're looking to raise. And who holds and where are the budgets and what are they? It's always a question you can ask. Something I learned very early on in my sales career was always ask if you've got the money and you're prepared to spend it. Because if you're not, then you're wasting your time. If there's no money, and you can have a lovely conversation, but it's not going to get any further. The biggest mistake, I think almost actually, not one of the biggest mistakes, is companies not talking to their customers early enough or enough. Get your product, your service, your idea into people's hands so they can give you feedback. This continuous customer feedback is absolutely critical, because if you don't, you could easily be literally producing the wrong product, even though the market's there, etc. The competition. One of the great slides we see all the time when people come to us is a lovely matrix with the competition on one side and a series of features on the top. And the competition has lots of X's in that matrix. And then at the bottom is your company, and there's lots of ticks. And it looks absolutely great. But actually, if those USPs don't matter, no one cares. So again, it's about being very objective, that you need to be really, really objective, that your USPs matter, and that you've analysed the competition objective and done some real homework on it, rather than, oh, they're useless, we're much better, which is, again, a thing we hear quite a lot. And the other thing is people who come to us and say, there's no competition. Well, there is. The status quo is the competition. Doing nothing is always an option, and actually usually it's an option because no one loses their job for doing nothing, unfortunately. So again, The theme for this is being objectivity and analysis, I think, is probably if you have to take a take home from what I'm trying to say. Lastly, the funding journey. A pharmaceutical, a biotech company developing a new chemical entity to market is going to be costing in the billions of dollars and taking a very long time. Now, that journey may get truncated in many different ways, but you're talking about a lot of numbers of funding rounds and a serious amount of money. A service business where you've got something which you can already sell may take very little. Those are sort of the two ends of the spectrum. But you need to think about how much money is it going to cost to get your product to market, and how much money will it take for you to get the sales so that you can actually stand on your own 2 feet. And if this looks silly, or there's a series of binary bets with progressively exponential increases in the amount of money you've got to raise, you're going to have to think quite carefully about how you go about that. I haven't talked much about numbers in this, because people will come to us with forecasts, which are always meaningless at this stage in the business. We want to see forecasts because we want to see what your ambition is. So a business which is expecting to turn over £1 million in 5 years' time is unlikely to be of interest to you. Admittedly, one which says it's going to turn over 100 million in 2 years' time is probably fantasist. So again, you need to think about these things. And you can't predict sales because your sales forecasts are inevitably going to be wrong. However, you should be able to understand your costs in detail. We want to be able to see what you're going to be spending over the next 12 to 18 months, because that's what we're funding against. The revenues are jam on this at this stage in the business. You need to get yourself to the point where you can either raise more cash or have sufficient revenues for the company to break even. What you don't want to do is to get 6 months down the line, have run out of money, and not be in a position to act, and you haven't proven your point, so no one's interested in putting any more money into you. So this is the point when you're coming to us. You need to show us that you can get the money you're asking to raise is enough to get you to the point where you can raise a further round of investing. And last but not least, be realistic. And that's on the valuation of your business, on the amount of money you want, on your sales projections, on your team, etc., etc., etc. Be objective. Just very briefly, just to finish up, when people come to us for seed round funding, we don't expect them to have a complete team. It's sort of impossible because there isn't enough money around to pay for a complete team. There isn't enough work to do for a complete team. And we don't expect you to have the answers to all these questions. What we do expect you to do is to have thought about them and being able to make sensible, realistic assumptions, which, if they can be tested, have been tested, so that it hangs together, it's coherent, and you have absolute ownership and belief in it. We do expect you to be engaged with customers, even if you haven't sold anything. It's a typical problem with academic businesses, is they tend to build something in isolation and then expect people to come out and just immediately buy it. It doesn't happen. Without talking to customers, you don't know whether anyone is in the slightest bit interested in what you've got. So passing the does anyone give a shit test, frankly, is again, an absolutely vital part of when people come to us. When you've moved on a bit, yes, we do expect you to have a complete team. Not the complete team of a multinational company, but a team fit for the stage that you're at. And we expect you to have most of the answers to these questions. We do expect you to have begun to sell product to live customers, and we expect this to be growing. As a rule of thumb, if you're looking for a Series A round, you should be turning over between £500,000 and £1.5 million. Doesn't mean you have to be making a profit, but the trajectory of that growth in sales needs to be going up. So there you go. That was a whistle-stop tour about a subject about many volumes have been written. I'm around for the rest of the afternoon, so if anyone wants to have a chat, just come up and approach me. And has anyone got any questions?
I just have a question on the numbers, because these numbers seem to be about right in terms of funding for, say, software companies with investment. But in companies like in photonics, typically there is a lot of capex investment required, massive investment. So the problem is that there might be even to get to the level
Yeah.
of maturity of a seed, you might need
It's a very good point. I mean, numbers are to a certain extent very specific to where you're at, and the investors in that particular space will understand that. But I suspect what we're looking for you at that early stage of a photonics business, is where do you find the access to the capital equipment? You shouldn't have to be buying it yourself, for example. That's part of what CPI does. It provides you with an environment of where you can go and you can use bits of kit which you could never in a million years afford at the stage of the business that you're at. Innovate, the grant environment around this particular sector is relatively benign. So you should be looking to leverage every single penny of money that we can. So, for example, we often cash flow innovate grants. I'm doing one at the moment. So typically an innovate grant will pay you 70% of the total value, but the worst thing it does is it pays you quarterly in arrears. So constantly you've got to pay for yourself during that period. So we're happy to, we've been involved in a number of businesses where we've been providing the cash flow to enable an innovate grant to actually take place. That we would definitely put that in our proof of concept. We're actually doing one at the moment where we're sort of pulling together grant monies from loads of different spaces. And we provide the sort of working capital glue for that. And it's a much larger round than we would be prepared to do as a pure equity investment. But once you put it all together, it actually it actually begins to make quite a lot of sense.
Alex, can I ask another question? Do you always make it an equity stake, or could you maybe explain?
We're an equity business, okay. So generally we're taking an equity stake. For where you are in your life, debt, because you ain't got no revenue, debt is very difficult to do. We do invest via what's called a convertible loan, where you put it in as debt, but then you convert it into equity at an agreed price at some point in the future. The reason for that is usually the speed and ease of it. It ends up as equity, really, at the end of the day. There are funds, part of the Northeastern funding environment, are funds which do debt and mixtures of debt and equity, but they're looking at businesses which are much more established. So round about this, once you're looking at the Series A, you're turning over some money, then it'll be debt. It's very difficult to do anything other than equity at the stage where in the early stage.
One more, Bob.
One thinks of VCs as one that we in and out in 5 to 8 years. What is the sort of time scale, maximum time scale?
I wish. I think it's probably the first answer to that question. It's an interesting, it's an issue which people are grappling with hugely at the moment. I mean, for example, our first ever investment, which was made 14 years ago, is just beginning to come true now. If you look at the billion-dollar exits of Skyscanner and FanDuel, which are two software companies, they would have been worth pretty well nothing after 10 years. They made all their capital gains, or the gains in the valuation was after that time. So although we love to see people come and say we expect an exit in 2 to 5 years, it ain't going to happen, or very, very rarely. Our funds are 10 years in duration, but we do have the ability to extend beyond that, as you can see by the item I mentioned. We have to be pragmatic. The problem for us is, and this gets into the technicalities of running funds, is that after 5 years we cannot invest any further. So we're very vulnerable to other people coming in saying, well, actually, screw you, you don't matter anymore. We're going to do a down round, give the management lots of options, and you suddenly find your position immeasurably weakened at that point. So it's a tricky conundrum. And it's one with all early stages investors. But the government has recognised this, which is why they're beginning to talk about patient capital properly. But the trouble is the tax structure isn't geared around patient capital. So the tax structure for things like venture capital trusts and for EIS funds and what the British Business Bank has, which is called ECF funds, it isn't geared around it, unfortunately. And until there's a change in the tax regime, it's going to be, there needs to be some structural changes in the industry, to be honest. But in the meantime, we muddle along by basically just not saying anything until we have to. So.
All right, one more then, Andrew.
Do you tend to take a controlling interest? Or?
No, we don't take a controlling interest from a shareholder point of view. We do try and exercise an immoderate control of influence, amount of influence for the stake we have. So, for example, we will put someone on the board. We will have shareholder rights, which are probably more than you would as just an ordinary shareholder. And then as a European fund, there's a whole bunch of things that we have to have in terms of reporting and information and things like that. So yes, I mean, if you take outside investment, that outside investment will come with strings attached. It can't not, just from government's point of view.
Okay.
Okay, gentlemen, thank you.